And thank you for coming to the Investment Advisory Committee. Do you mind if I?
Oh, yeah, you can take your mask off.
Okay.
Yeah, that's great.
Do you mind if I talk this way?
That's fine.
No, that's fine.
We are streaming, so being near a
Oh,
microphone
that's
helps
right.
is
Near-
helpful.
Talking to the mic.
And I'm sure there are going to be millions watching. So.
Well, good morning. Really appreciate everybody coming. The Investment Advisory Committee is made up of Commissioner Lewis and Commissioner Benton, and the treasurer, by the way. Tomorrow will be my 30th day in office, so I don't know if I'm going to have a party tomorrow afternoon or go to bed early. I wanted to introduce some folks, and I really appreciate everybody coming. We're going to do two presentations today, and it's kind of like the state of the investment conference or whatever. So I want to lay out where we've been for the last 12 months, where we are today, and where I hope we go the next 12 months. And I wanted to start off by saying, a good friend of mine that Barb and I had breakfast with yesterday, he said, Don, you need to let them know why you wanted to become treasurer, why you wanted this particular job. So I was just going to take a couple minutes and do that. Another colleague of mine that doesn't live too far from me, about a year and a half ago, said something to me at a meeting we were and suggested that I think about it, and I did, and I took a look at the treasurer's position, and I thought I could bring some real-world business experience to that position, and it was the right time because the county has grown so well. They've grown so smart over the last 20 years. If you took a picture of what we looked like in 2020 and what we look like today, it's amazing. And obviously, majority part of that has been the commissioners and the county exec and the county economic development director and auditor Kaitsa. I know Melissa Schiffel wanted to be here. She's so young, she still has kids. I miss those days. Anyways, so I thought about it and then looked at it and said, how can I do this? And I know there was probably a little bit of anticipation. I don't know if anticipation is the right word in regards to me being treasurer. So I hope that the first 30 days, you can see how I'd like to see the treasurer's office work with the other, with the commissioners, with the auditor, and with all the other elected officials, prosecutor's office. So we have two major presentations. Before we do that, I'd like to introduce a couple of my staff, Doug and Jessica. And they're our senior people, and without them, the first 30 days would have been much different. So I thank them for that. Rick Carr has helped tremendously. Hopefully, in the very near future, I can get my budget a little bit bigger than it is, and I hope we can bring Rick on. I'm not gonna kid you, I'd like to bring Rick on as our chief operating officer. He would do a great job with that. I've known him for a few years and got to know him, and he'd be a perfect fit personality-wise as well as knowledge. Tyler Lane, I don't know if he's happy about this or not, but Melissa Schiffel's office has assigned him to the treasurer's office, and I'm going to use every resource I can. He's a great one. I really appreciate that. I see Eric in the back, and I think Eric and Tyler will do real well in keeping some of the things that we want to do moving along. Bob Lamb back there has been a big part of where we got today over the last 5 years. Robin is our PR person, to really appreciate. And then obviously Mike Fromer has been a good
I suggest you run for the office. That township meeting.
Oh, I-
He said that, not me. Anyways, it was Mr. Fromer, and I appreciate that. I think we're going to have a lot of fun and make a lot of progress. Obviously, Commissioner Merrill has been a friend for a long time, and the three of you put me on the Finance Authority 5 years ago, and I think we've done okay there, and they continue to grow. So with that, gotta make sure I didn't miss it, but I know George is here, and I appreciate that. I've asked George to sit on the loan advisory committee with Melissa and Mike, and he has graciously said yes. I think he'll be a big asset to that committee. So, and I don't know the young lady with the glasses.
I'm first. I'm the fiscal manager for the commissioners.
Oh, okay. Well, it's very nice to meet you. They don't let me get anywhere near you for there must be a reason for that. So my badge doesn't even work to get in the building. So I guess I got that. Yeah, I guess So we have two major presentations, and the first one is going to be by third. What I find interesting is that Brian and Mike reached out to me a week or so before I took office. And that really meant a lot to me. And they've worked, literally, we've talked every day. I think literally every day we've talked every day. And so they put together a great presentation of where we've been, or where we've been for the last 12 months, where we are today, and hopefully where we go. And then the next presentation will be Bob Lamb. But anyways, I'd like to introduce Mike and Brian.
Thank you, Don. Good morning, everybody. Done many presentations, both at the podium, new to us, so we could make that work too. Come on, just anybody not get one?
You, Brian, do you want to make sure you put your mic down, right, yes, near where you're speaking, right? So our large audience that's watching can hear
This is good,
every
right?
word.
Everybody hear us all right?
Thank you.
And this is meant to be as conversational as possible, so there's obviously people 360 degrees, so
Please.
we're going to try to make it as conversational as possible too, and informal in that sense.
But you do need to stand close to the microphone.
Yeah.
Okay.
Yeah,
As you're
Okay, we
speaking.
will.
yeah.
We'll go ahead and get started. I'm Brian Carter. I've been with Fifth Third Institutional Investments as a part of our capital markets group for 21 years. This is Mike Savage. He's been with Fifth Third for a little over 15 years now in the capital markets group. For any of you that do not know us, we specialize solely in the Ohio governmental entity space. So our day-to-day task with client interaction, we specialize solely in county governments, school districts, townships.
Any entity that is ORC compliant
Okay.
and has to follow the guidelines set forth by ORC 135.14.
Okay, thank you.
The first slide we want to spend a little bit of time on this morning, and this is analysis of March 2020 to the present time. What we outlined here with the help of Rick Carr is the county's total cash and investment balance March of 2020 through February of 2021. So working from left to right, the first column there labeled total cash and investments. This is the county's total cash, whether it be your local bank balance, Star Ohio, plus any of fixed income investments that were in custody at Fifth Third and a few other broker dealers at the time. if you look at the very bottom, the weighted average cash balance over the last year was $325,378,299. To the right, we put together what your weighted average yield of all of your cash for the county over the last year. So this included all fixed income investments, along with your cash that would be sitting in bank deposits and or Star Ohio.
This is everything. In other
Everything in
words.
aggregate. The absolute peak of yield was March of 2020. I think everybody is familiar with this pandemic we've been in for the past year. Prior to the pandemic, rates were much higher than they are today. So we think it's very relevant for you guys to know in aggregate of how much money you guys have had over the course of the last year and what you were earning on it in order to illustrate where things are today. So March of 2020 was the peak of the fixed income investments. Of your $261 million last March, $117 million was invested in fixed income investments. To the right, that is highlighted in green, we wanted to illustrate to the board the investment portfolio balance as a percent of your total cash. We think it's very relevant for mapping out liquidity management and for the Treasurer's Office to keep a higher concentration of the county's overall cash invested at all times. So what we discovered was over the course of 12 months, from March of 2020 through February of 2021, on average, 30% of the county's total cash was invested in fixed income investments.
And in discussion with Treasurer Ranke about that number, we've concluded it has been low and it can be improved upon. Every entity that we work with is different in terms of budget and in terms of impacts on that budget. With Delaware County in particular, we're very confident that that number could be higher, and therefore more beneficial to the bottom line of the county overall.
Yeah, one important thing to consider, though, is as property taxes are collected in January, February in particular, and then June, July in particular, the overall investment portfolio really gets inflated, but it's a very short-term situation.
Correct. Absolutely.
So I think the proper way to look at it is to look at the base, the lowest balance, during a year, compare the investment portfolio to that. Because you wouldn't invest, the money you collected for property taxes, because other than maybe 30 days or something like that, you wouldn't go longer than 30 days just because you have to distribute those funds very quickly to the school districts and the others. So I think the 30% is a little low. I think we're really closer to 40%. I think the baseline is probably 250 million, and roughly 100 million is roughly 40%. So just an important point. We can't
Yes.
invest those short-term property tax proceeds much.
Absolutely. That's Brian and I also are stewards of county government money in 12 other counties throughout the state, and that's absolutely a phenomenon. It's not a phenomenon, but it's a cycle that everybody experiences. So you're absolutely right, Commissioner Ben.
And I think what they're going to show later on is that we used a baseline of about 260, and Bob's going to show a program that's about 50 million, which would leave about 210. And the conversation that you and I had the other day about, what would be a good reserve number to have in the bank at all times, that's not something that I've been able to determine yet. And I think you had a great idea about the CFO working together with the CIO to come up with an overall strategy. So we even though he's showing all of this, the plan is based upon 260 and set aside 50 and then doing an investment. And as you'll see later on, they're looking at 185, 200, and 215 in their projections going forward. Yeah. So it's a good point, though, Mr. Commissioner.
Yeah, a very valid direction we're going, and that is, even if we have 100 million, 40% invested, that's still way low based upon our projected cash needs and reserves that we need to set aside. So do we need to invest 100 million more? I don't know, we'll get into that discussion and do some modeling to fine tune that, but.
Correct. It's definitely a group discussion here, and much of this was to present different scenarios that are possible.
The last thing we wanted to illustrate on this slide, and we'll move on, is the weighted average yield of all cash plus investments month by month. The peak of interest rates was last March through today. On the margin, the county averaged 0.71 of 1% on all cash plus the fixed income portion of the investments for the county. Anybody have any questions on this slide?
Okay.
Fair enough. As a continuation of what Don has already alluded to, we were asked to illustrate what's the opportunity cost of the county's cash that was uninvested over the course of the past year, okay? Granted, none of us know how much of that county's cash could have been invested at one given point in time, so this is strictly an illustration based upon the guidelines that Don asked us to do based upon 3 scenarios.
Okay.
Having $175 million of the county's money invested all of last year, $200 million, and then $215 million.
Correct.
So as of March of 2020, what this is showing you to the far right, the peak of interest rates with a fixed income portfolio at the time, 1.83% yield is what we used as a guideline.
Yep, that's for what we were stewards of at that point in time for the county. This was the book yield extrapolated from our investment reports for what Fifth Third was holding, what those investments were earning, which was what we used as our baseline.
What we have discovered is on $175 million of investments over the course of 2020 through February of 2021, the county would have realized an additional $1.2 million of interest.
At one point, at 175 million.
At 175 million balance. So if you flip back real quick to the first slide, at the very bottom of the first column where it says total cash and investments, we provided you guys the illustration of what that 0.71 of 1% meant, of how it was already being dealt with last year. So the county should have realized roughly 2.3 million of interest receipts last year. Okay, so I'm going back to the next slide. The purpose of that 175 million was to illustrate this is in addition to the 2.3 million that the Treasurer's Office has already realized.
So in essence,
Okay.
these are figures from the past that now have passed us. We can't do anything about to capture that, but it illustrates. It's sort of a 2-part presentation. The first showing the past, what would have come to pass had we done this, and the future, what it will look like based upon a portfolio model we put together for current interest rates of what additional income the county would come to expect in these 3 scenarios as well.
Okay.
Yeah. And this is a very important schedule. We can't get that money back, but if we'd been proactively investing as we should have been, we would have earned $1 million plus of additional interest income. But
Yes.
to do that, you need the tools, you need the resources, the staffing, et cetera, and that's, I think, part of the big part of the discussion today.
And I think the bigger picture here, too, of us being outside vendors representing you guys the best that we can, I think this balance sheet of the county is growing year over year, and it deserves a set of eyes on a daily basis. I really think that we make ourselves accessible as frequently as needed, or as infrequently as needed, but I definitely think that the Treasurer's Office, with all of the transition that has happened from the previous treasurer, I think a lot of time has passed where moving forward, this is going to require all hands on deck to get you guys caught up at an exponential pace.
I'll also take a moment just to say something that I want to make sure we say. Brian and I have had a pretty extensive history with the county through now 4 treasurers, and the past treasurers that we've interacted with and had relationships with were very good, and we're good friends. And now, going forward with the growth that the county has experienced and is continuing to experience, it really has come to the point where daily or every other day, a set of eyes should be doing this. And that hasn't necessarily been the case in the past, but should be now. I think the growth really merits that. You guys certainly are a large enough entity to require that. I just wanted to make sure I said that. I don't think we said anything about past history too.
The next slide, analysis of March 20 to present. We've created a summary for everybody because the numbers are large. This is a summary of had we invested a balance of 175, 200, and 215 million. The annualized income for $175 million cash balance at the time in investments would have been 3.5 million. For 200 million, 3.9 million, and for 215 million, 4.1 million. That's a big number.
This was also based upon a point in time when the prevailing interest rate curve was offering 1% to maybe 2%. The peak of interest rates in the last 10 years was the end of 2018, the third and the fourth quarter, when rates were healthily in the twos. Part of the discussion about the portfolio allocations that we would put forth now has to do with the fact that rates are near zero. They're better now than they were, but we need to be very cognizant of the fact that now isn't a point in time when we should go out and buy a bunch of long-term investments because rates have started to trickle up to really make these numbers look better. We need to be projecting conservative figures, and that's what we, in spirit and in actuality, did with this presentation. So,
And in my mind, you know, I look at the 1,850,228 number is probably the most realistic number that we left on the table because we don't have another program. You know, Bob's going to talk about a $50 million program, so, but that wasn't in place last year. Okay, so I think it's realistic to think that, you know, we could have laddered invested, you know, 215 million, and I think what we've actually left on the table is about 1,850,000, which, you know, to me that's a lot of pennies. So.
And just to reiterate from slide one, the average investment balance for the county in the past year was 98.5 million. Okay. So Don's point is well taken that if your average weighted average cash balance of 325 million, even though that may be a little high due to collection timing, there's a substantial amount of cash there that more than likely, if we map it out of your low points of cash and your high points of cash, these numbers are probably not too far off the mark for planning purposes of what your overall fixed income portfolio of the county should look like.
correct.
Excluding the 50 million you have mapped out for bond funds.
Proposed
bond funds. Does anybody have any questions with what we illustrated? It's a lot of data, so we want to make sure that.
I think it just illustrates that effective across the county cash flow planning is critical. And if you know exactly what cash you need to operate, all that excess can be invested in for the future.
Part of the platform that we have as well in terms of analytics is a model cash flow report that shows you on a monthly basis the projections of income and principal that would pay every month out 60 months. So that's something that we're already sending to the county on a monthly basis, but will certainly be a very pragmatic tool for what you're talking about, Rick. So absolutely.
And what was your average cash balance?
That was the average investment balance of everything. So what Fifth Third was stewards of, various other broker dealers. I keep forgetting to lean to the mic.
Then I also add to Commissioner
Absolutely.
But we're not talking about anything over 250 or 260. You know, we've said, you know, I look, George, Mr. Auditor, I look at, I'm getting used to this. I just really am. You know, it's been an adjustment over the last 30 days.
Like a George.
So, you know, we aren't looking, I think Commissioner Benton said, hey, you know, 250, I mentioned 260. We're probably both right in that respect. So we're not looking at anything anywhere near over the 250 or 255 or 260. We're not. So this is, before I came into office, as you know, my predecessor was kind enough to let me work basically full time. And so I was looking for the lowest hanging fruit, and this just kept, this kept just hitting at me every day. So, but we're not going to do anything we're never going to ever do anything to not have the advancements ready to go. Okay, so this plan is basically going forward is 250 or 260 or somewhere in between. And I think as we go down the road, that fund is going to grow because we've been good stewards. And I think we've done a tremendous job with smart growth. So.
As Donald had said, it's sort of a two-part presentation. If anybody doesn't have any questions about what we've gone through so far, this is the fluff area, but we'll keep it brief. This is really just to paint a picture of, starting on page 6, how the pandemic affected interest rates and how we got to where we are now, and now that we're here, where we feel like we should be going. So. The first graph should show the progression of the Treasury curve January of 2020. So what you're looking at, the top dotted line was the interest rate curve at that point in time, which had become, you can see how it's kind of flat. And what that indicates is that the economy typically might be slowing. So at that point in time, if you bought an investment that was 1 month in maturity, it yielded about 1.5%, the U.S. Treasury, that is. And out to 5 years, it would only yield a little bit more. So to us, that looks like a point in time when something could change drastically one way or the other. Now flipping to the next slide, in February of 2020, you see that red arrow. That in our world of fixed income investments and watching the market, what you're looking at is an inverted yield curve where when you are buying a longer maturity, it yields less than a shorter one. And that has typically meant through different cycles that rates are probably going to fall, the economy is decelerating, there is potentially some panic that could start to loom, and that is a point in time when you start thinking about locking in longer term interest rates to protect from that. If you turn to the next slide, March of 2020, it really started to ramp up. This is kind of, my family and I went to Disney last January, and we got in just in the nick of time because by February and March, that wasn't really an option anymore. That's when the NBA started shutting down games. That's really when panic started to ensue because the Treasury curve was starting to really compress and almost turn into a U shape. And then if you turn to the next slide, which is probably the most dramatic, by April, rates had tanked. So at that point in time, a lot of our clients were asking us, why would we invest in something longer that yields less than, at the time, Star Ohio, which was still really high? Well, there's in terms of performance, there's two components to any investment that we really watch more than anything in terms of performance: yield and duration. And those two things have to make sense at that point in time, along with liquidity, along with obviously being ORC compliant and safety of principle. But by this point in time, the damage had already kind of happened. But to accelerate to where we are today, which is on slide 10, this is the interest rate curve as of yesterday. Although the short term, basically rates inside of, let's say a year, are still very low. The shape of the curve now is much healthier. It's signifying that things look better. It's steep is what it's called. There's actually slope to it. So the further you go, the higher yielding investments you get. And right now we're kind of at a place where, actually this morning, there's a Treasury auction. The 7-year Treasury is auctioning today. Several weeks ago, the 7-year Treasury auction was one of the worst on record. And that really lifted rates to a place that was sort of in the investment world that we watch every day, new and exciting, because rates had finally kind of come off the floor. So watching again today, there is some economic data that's coming out as well that could, if things don't go very well, it could lift rates again. So we're in a much, the point is we're in a much better place now than we were even 3-4 months ago when rates were really at the floor. And we are in a position where obviously the county has large cash balances that we'll be able to utilize in the marketplace to do better with than had we had this conversation 3-6 months ago. Rates were about as poor as they've been in both of our careers. This last cycle, it was just about as bad as it ever got. Does that make sense so far? Okay. Okay, page 11. It's just an excerpt from Bloomberg that I won't read verbatim, but it just basically describes how the economy's looking rosier, how longer term rates are starting to move upward, and sort of re-solidify where we're at in terms of our thought process right now. Page 12. How are we on time?
How are we on time, guys?
You could lose track quick.
Bob, how long are you gonna take, 30 or 40 minutes? 15. You're good on time then.
If you told me we were up here for 10 minutes or an hour, I would believe either one. I have no
I
concept
think
of time.
I mentioned 45, but I think you probably got another 10.
Okay, okay. Economic data that has been released in the past 30 days, as well as 3 important numbers today that are hitting 5 minutes ago. Annualized GDP. If you look at that bottom line, that's a pretty important one. 4.1% is the survey, so we'll know in a couple, should know by now what the actual was, and if that number was good, it further solidifies inflation and is an argument for higher interest rates. Page 13. To get right to the point of what this is talking about, ignore everything except the middle column, the percentage chance of a hike or a cut. This is the Fed funds rate, which basically dictates a large part of the short-term interest rate curve, which is why short-term rates are still so low. The Fed funds rate has a likelihood of being raised in the next year that peaks out at about 3.1%. So it's still it's a very low chance that the Fed is going to do anything to lift short-term rates. Longer-term rates, 3, 4, 5 years, that could be different because they tend to move in the direction of where longer-term treasuries go. And if you would go to page 14, Brian will do, this is just a list of the investment options that we thought was prudent.
And I want to make sure you explain to everybody
Yes.
laddered investments so that, because times are changing. Who did that song? Anyways, shows you how old I am. It's a 70s song. Bob Dylan, times are changing. So we're in that situation. See, George and I would know that. And times are changing.
Good song.
And to be as conservative as we can to make sure that, if the commissioners call over to the treasurer's office and say, hey, we need 50 million or we need 25 million, whatever we need, we're going to look at this laddered investment strategy. So
What Mike and I thought was relevant in one slide for anybody who are not investment professionals in the room, the county has very strict investment guidelines that they have to follow. So as we're talking about investments, everything that we are referring to are fixed income. So the intent of any investment is to hold it to its stated maturity date. You're not actively trading each individual investment that the county may own based upon volatility. So through the budgetary process and cash flow forecasting, our job in working with Rick and with Don is to map out what Don referred to as a laddered bond portfolio that basically the county has overnight cash liquidity needs out to a maximum stated final maturity date of 5 years. So slide 14, we thought it was relevant today to at least illustrate what the options are for county governments. That way, if you're unfamiliar and someone says, well, why can't we do more yield-wise? Well, it's based upon the confines of the state law in order to protect the principle of the county's funds so that you cannot, I don't know, lose money is the correct term, but you have to really work at it to lose money based upon the way the county's laws are that you have to follow.
They're really designed to maintain safety principle. Liquidity, if you go outside of these confines, you're out of compliance, which is something we aim to never do. And
Yes.
there is, with one exception, what Brian had said, there was a change to the ORC with regard to Ohio municipal bonds. You're allowed to now invest in Ohio municipal bonds that go out a full 10 years. That opens up potentially more duration risk, that if rates rise, those investments, you'll hold them more than likely for longer unless they're redeemed early for any reason. But what that can mean is with large interest rate fluctuations, they can quickly not look as attractive as they did when you bought them. So that's part of the liquidity management component that we would need to keep a watchful eye on, and frankly isn't part of the model portfolio that we put together right now. But this is a good list just to have, so you have reference of it. Page 15, this is the last component of our presentation. So this has to do with the model portfolio of what we used prevailing interest rates, what's available in the marketplace today, to put together projections. And as a starting point, as you can see, investment balance of $49,550,000. That's what Fifth Third is stewards of today, at a book yield of 115 as of the end of February. And that annualized income spits off about $569,825 on that pot of money. If you were to increase those, if you were to increase that investment balance by going out into the marketplace today, you would expect the overall book yield to go from a 115 to a 57 basis points because of the current interest rate environment and what's available that's ORC compliant. However, because you're putting more money to work, that increases the income improvement in that particular instance in the corresponding green box on the right by a little over $300,000, then $400,000, and $463,000. So there is still advantage to do that, obviously, by putting more money to work and taking it out of overnight investments such as Star Ohio, and doing that. And by doing so, the model that we put together has the corresponding bar chart of maturity. So it would be more heavily front-loaded because of where we are in the current interest rate environment. And overall would have a duration of about 1 year and 3 months. So as rates adjust and as the economy sort of plays out, we will have the option to do one of two things: either to reinvest the short maturities at higher rates, or obviously address liquidity as it's needed as well, and really get a feel for that over time. Does anybody have any questions about that at all? If you'd refer to the example portfolio, we had to print this separately because it was
Too much.
It was too small for the slides, but what you're looking at are the current holdings of the county that are in white, and green are examples of current market offerings that we pulled. For example purposes only, by the way, this is not any suggestion that we are making or any recommendation today, but this is just for modeling purposes. And what that would look like overall. So the green lines are examples of different offerings that we pulled from the marketplace, which give us those projections. So overall, the book yield would be around a little over 0.5% for a duration of a year and 3 months. And the goal, obviously, being over time for that to grow.
And Don already asked us prior to this meeting, are you sure that that's all we can get? As investment professionals, we always like to use the word yes. Yes, we can do better. But as Mike already alluded to, at this given point in time, because you can't rewind the clock, what you have to look at now is liquidity risk, as Mike already illustrated, but also duration risk as it relates to interest rate risk. We can improve that 0.5% or what have you if you have a larger percentage of the county's cash invested in longer duration investments. But the downside to that is, for planning purposes, is what happens if and when the economy continues to pick up steam.
Right.
Do we want to see an underperforming?
No.
In,
This is in our career, this is our third interest rate cycle, and the last two certainly have shown that if you buy longer term investments when yields are low and rates move up, they look pretty poor pretty quick. So we aim to avoid that and manage that.
And I think Brian's point, which is a very important point, is that I think that the commissioners with the county treasurer and the county auditor and the county prosecutor need to work on a annual plan so that we know what the commissioners are looking at in regards to buying property or making other investments, so that the treasurer's strategy, and it's not the treasurer's strategy, it would be a county strategy. And so, I'm proposing, obviously, to hire a chief investment officer that would work very closely with the county exec, Mike Fromer, and work very closely with a CFO, the county commissioner's CFO, or the county commissioner's director of finance, or whatever we can put together, and would monitor that plan monthly. But it would have a flow that the treasurer's office and the auditor's office and the prosecutor's office are all in flow with what the commissioners want to do, and make sure that we can timely react so there's always a positive outcome. And so that's a big key to this. And, it's between Eric and I'm showing my age again. So Tyler, between Eric and Tyler, they would also be on that team of professionals, and that plan would be a working plan. But like I said, it would allow us to make sure that legally, financially, and investment-wise, we could always meet the needs of what the commissioners have. Now, with that, would you explain to them, because I think this is a key thing. I know that the commissioners would always ask this question. I'm going to ask it, and you're prepared to answer it. Tell us how your fees work.
Sure.
And tell us, where you can save us some money in regards to what we're currently doing. So.
Sure. With regard to the way we're compensated, when you buy a new issue in the marketplace, there are two things the issuer of the debt, whether it's Fannie, Freddie, the Federal Home Loan Bank, a CD issuer,
or Olentangy School District,
or a local government that's issuing you debt, when they go to bring the debt, they pay two things: the interest rate that's agreed upon when issued, and then an underwriting concession for that. So we're paid, which what we would be planning on doing is sticking to new issues for that purpose. We're paid by the issuer to remarket that debt. So there are options available out to you, out in the marketplace to you as a local government, that are what are known as fee-based, that are compensated with hard charges that are deducted from your account. That's not the way our platform is set up. So by going to the issuers of the debt and buying from them, we're compensated that way without deducting any money from the county's coffers, if that makes sense.
So the yield that we are able to obtain for the treasurer's office, from a budgetary perspective, that's what you guys will actually realize. There won't be deductions from those interest receipts.
I don't blame you for asking that. I mean, it's
Does that interest rate tend to be a little lower because they're giving you the commission or
There are times when there are offerings that are certainly from that purpose, but the way that we've approached our business is more so a volume of working with accounts that get interest rates that are better for that, so we don't typically do that. It can be that way. It's hard to nail down because things change every day, but that's certainly something that does exist in the marketplace for sure.
My only point was sometimes the fees are there that just kind of hit it, for lack of a better word.
Absolutely.
The question I have is, we need to get into this sooner rather than later, and we are gonna be laddering, so you can't put everything to work at one time.
No.
So the sooner you start that process, the better. I assume you'd agree with that.
Yes, it would. We talked about this sort of
Yesterday.
informally to ourselves about the time frame it would probably take would be over the course of maybe a month, maybe 3 weeks, possibly longer, possibly shorter, but
And you're allowed different maturities during those processes. to
absolutely,
Spread it out.
absolutely. Liquidity management is a huge component of this, not just if something looks good, go buy it because you
If you
think it
just
looks
hold on
good.
to something that kind of worried me, because some of these cities are not great, I assume you'd be very selective in municipal bonds that you would look at.
Absolutely, yeah, part of that is looking at the budget of the entities themselves, what impacts them economically, what their track record looks like, their tax base. I mean, all sorts of components that you would evaluate a municipal differently than anything else, because when you're buying a CD or a government agency bond or a treasury, you don't tend to evaluate that unless there's some macro event that is reshuffling one of those entities. Municipalities, local governments are totally different, so we would look at that as a part of the analysis when looking at an investment to pursue. Absolutely. It's a really good question because it's, in the past, Ohio's been pretty sound overall. There haven't been a lot of troubled entities. There's been some, but
Well, I can name a few cities, Chicago, San Francisco, LA.
there's a few.
Name a few.
Seattle.
We
Any other
stick to
questions?
Ohio too, so you have to stick to Ohio.
Oh, so yes, yes.
It has to be in state. I don't want to pick on any entities in particular, but I'm thinking of one that had a very disagreeable administration that led to them being downgraded to junk. That would be something we want to stay away from.
If I could just add a comment, the municipalities have gotten in trouble in the past. I think it was Cleveland or maybe Cuyahoga County, you probably remember, George, that invested in derivatives
Yes.
and interest rate swaps and some other products that are very advanced, and unless you really know what you're doing, you have no business being in those. And they didn't know what they were doing, and it hurt them dramatically.
Yes.
And now the higher revised code doesn't even allow it, so it's not even a consideration. But you do have to be careful, to Commissioner Merrill's point. I think my takeaway is what the presentation shows is that with better management, we can significantly increase the portfolio yield and still preserving appropriate reserves, planning for future expenditures, such as the Bixby campus, and modeling that out. Now, Mike has led the charge in terms of getting a financial modeler on board, and we now have a good financial model for the general fund that is a good starting point, and we need to continue to work with that. But it's going to take permanent staffing. I mean, we can't use this outside third party forever. And this is just one thing that this financial expert would provide for us. Another thing is the debt modeling. That was the background of why we did the modeling we did, was we know we're going to have to issue some debt, but we don't know how much. And if we issued too much, that's a real waste of funds. If we issue too little, that creates a little stress on the system. So again, we've got to have the expertise to lead us through this to make sure we do invest appropriately and significantly increase our yields. So again, that's my takeaway, and I think that's where you're headed as well.
I think so, yes. It's the plan.
No, the active management is really needed. It's a big figure that we missed out on. So, no, again, from our end too, I mean, we have a lot planned, and the Bixby campus, for instance, that we're discussing now, and our administrator's been working on that and getting projections and everything, but yes, you know, we'll have to make sure that we're giving you all the correct information so we know how much to lay aside, and then again on the bonding. Got to keep George happy.
But we all want to keep.
Standard Poor's.
That's right. Yeah.
Very true.
It's a balance. It's a
We all
balance.
want to maintain that AAA. There's a
That's
whole bunch
right.
of advantages
That's
to
right.
that.
Yes. Yeah. Absolutely.
Well, thank you.
Yes,
And those were,
thank
by
you.
the way, excellent points by all three commissioners. But thank you, and we appreciate your presentation. It was great, and we look forward to hopefully working with you very soon. So,
We want to publicly say thank you for your business. As Mike alluded to when we started this conversation, we've always been here, frankly, but we've never been here. So
At the county level. Yeah.
this is our first presentation to the advisory board over the last 13 years that we've worked with the treasurer's office. So thank you for your time, everybody.
Yes.
And thank you for your business. And we are available for this advisory committee as frequently as you would like to hear from us. We'll coordinate that with Don as he sees fit. But if any of you have questions for us, we're always accessible via email. So just let us know if we can answer any questions that you have.
and I want there to be an open door. So if any of the commissioners, or even our auditor, or our prosecutor, if they want to pick up the phone and talk to you directly, I have absolutely no problem with that at all. So we're going to have a very open door, very transparent window at the treasurer's office. So I think that's important because we're a team. You know, we are a team. So, but thank you,
Thank you.
for your
Yeah.
presentation. It was
Thank
well
you
done.
very
Thanks,
much.
everybody.
Thanks, everybody.
Thanks, guys.
Next, not yet. So I need to say a word about Sarah. So I didn't say anything about Sarah. You know, Sarah and I first met, which was great for me, probably wasn't that great for her, 5 years ago on the Delaware County Finance Authority board. And it's really nice to see a friendly professional face at these meetings. So thank you for that, Sarah.
She's kind of hiding there. No mask.
Our next presenter is Bob Lamb. Bob is our County Economic Development Director. I think of him much more than our County Economic Development Director. One of the terms that I've used several times today is smart development. And I think that the reason why we are where we are today, and again, I think the commissioners have done an incredible job with their fiduciary responsibilities in being able to have these types of balances available to be invested. I mean, that's a big statement, a big plus for the three commissioners, and what they've been able to accomplish in this short period of time. It's a long period of time in regards to terms of office, but short period of times in terms of the financial world. And that's where we are today. So a big piece of that has been Bob and Dave. I see Dave Stage back there. He's been a big piece of it. I think that, you know, Bob's introduced TIFs and JEDs, and now we have some additional opportunities that I think will continue to help the smart growth of the county. And if we do things right, will give us an opportunity for a lot of additional potential opportunities down the road. So, Bob, it's all yours.
Thank you, Investment Board. Thank you for the opportunity to speak today. We want to quickly go over a proposed program that my office, the Treasurer's Office, and the DCFA have been working on. I want to thank Treasurer Ranke and Mr. David Stage, who's the treasurer for the Delaware County Finance Authority. They've been instrumental in putting this together. This has been a program being looked at for many years, and unfortunately, it's the conditions of today that make it have a lot of sense to move forward, but it's a great way to look at the challenges we've had to overcome over the past year and find a great opportunity for our community to move forward. And I know there's another meeting starting in about 25 minutes or so, so I'm going to go quickly, but happy to answer any questions that you have. So why are we looking at a bond type program? Really, it's to find a way to maintain that unparalleled quality of life that we find in Delaware County. We have enacted smart growth policies to help move this forward and to maintain that quality of life, whether it's supporting our school district, making sure public safety is in place, or that we have infrastructure that can take care of the needs of the community, while also trying to bring in job opportunities for our residents so that they can not only live here and raise their families here, but they can also work here in our community. Rationale for these different funds are many, but some of the key aspects right now are community needs. We know we have to be investing in our infrastructure, whether it's building new infrastructure, repositioning existing roadways or sewers, and then also just kind of the standard maintenance that is required to support our community needs. We're seeing low interest rates in the Star Ohio account. Currently, it was 7 basis points when this was written the other day. It is 8 basis points today, so moving in the right direction.
Moving right along.
The key to that, though, too, is when we look at even 2019 or 2018, what we see is about an average of 1.96, 1.8 on average for that account. So again, even in good times, not a large yield just from the Star Ohio account, and you saw that just from the JP Morgan Chase presentation that really highlighted our need to be very conservative in our investment, but smarter in how we invest. And then an economic development standpoint, how do we bring about infrastructure that will create jobs and diversify that tax base that will help maintain the quality of life for our community? We are looking at 3 different bond programs. One of the ones I'm most excited about is the local jurisdiction program. And the reason for this is a way for us to take existing community resources and reinvest it in our communities. Work with the local jurisdictions, whether townships, villages, or cities, to find ways to support their infrastructure needs and continue to be able to provide services for their residents and stakeholders, whether that is through road development or public safety investment. It provides a variety of ways for us to be a key asset in making sure those communities remain great.
And this fund here is the fund that we would have used with the Liberty Township refinance of the YMCA, and which I just, I appreciate being able to work with my predecessor on that program. We ended up at a 1.175 rate, and obviously I would have liked to see that a little bit higher, but regardless of that, that was for a 4-year period, and then it would jump by 50 basis points a year after that until it was paid off in 8 years. But if you look at where Star Ohio is today at 8 basis points, and that going out at 111, almost 112 basis points, significant difference. So it was a significant increase in income for the county, but just as importantly, it was a significant decrease with for the township, because those rates were projected to go to, I think, 325 basis points when
3.5%.
okay, 3.5. So the Liberty Township saved about 60% of their interest rate. So that was a great program. It was a great way to get started and kind of get our toes into the water.
And this really takes that concept and sets it up in a set program with a designated amount of funds that would be available to support those type of activities for our local jurisdictions. And we're proposing a 175 basis point starting point of review, contingent upon Treasurer reviewing market conditions and where things stand going forward.
It is a real win-win, I think, is kind of summarizing what you were saying. The local jurisdictions are very financially healthy, but they're smaller, and they don't have access to capital markets easily, and we do. And so, we're rated. They're in good shape financially, but it's difficult to issue small bonds. It's expensive, time-consuming, and we can do it much cheaper, easier, and we can get a better yield, and townships save money.
And the cost of funds substantially goes down for the township.
Right?
So, I mean, that's a huge point. I mean, you know, folks don't give that a lot of consideration, but the cost of funds go down substantially.
The second program is a bond fund with Delaware County Finance Authority. This would be used to support both private development and commercial growth within the community. Again, trying to find ways to put in place the infrastructure needed to generate new investment that would lead to new jobs for our community. And then the third fund would be
Well, let's stop there for a second. Jeff, that's Commissioner Benton, I apologize. The Delaware County Finance Authority is something that you and I and Bob and Mike have talked about for like the last 5 years. How do we put real money behind that? And so there's an opportunity to do that. Now, obviously, we're going to set up this advisory loan committee, which I think is a brilliant idea. Who came up with that?
I think it was you.
Oh, wow, that was a brilliant idea. And sorry, I had to say that. You got to give me a little bit of credit. I'm still in my first 30 days. So, or you gave me a little bit of rope. Anyways, it obviously something we have to look at very carefully to see if we can do it. But it, 5 years later, we're here, or we're potentially here. So I think that's.
And we've also seen success over the past year with the revolving loan fund. Obviously, it's been somewhat tempered based on PPP availability, but as that fades away over the next 3 months, we are expecting to see that fund to increase significantly in activity. And then finally, the infrastructure fund, which is very exciting. As we all know, one of the challenges we face is that infrastructure investment and how do we move forward different locations. This would work with both the private and public parties, whether it's a developer seeking to do a commercial project or a light industrial project within the community, or with the county engineer's office to advance their interests. We would be working together to move projects forward. In order to oversee the use of these funds, we are recommending that an advisory board be created that would consist of the county treasurer's office, or the county treasurer, the county auditor, the county prosecutor, the county administrator, and then the Delaware County Finance Authority treasurer, to make sure that everybody's interests are being reviewed, that we are handling things appropriately, and that the bonds being issued are for the best for the community. Additional checks that we've already laid out for this type of program would be the Smart Growth Checklist. This would be looking at private developers to make sure that they were undertaking projects that were in line with what the community wanted to see and that they had proven track records as well as the financial strength to undertake the projects they were proposing. A financial advisor review, recommendation, and underwriting of the agreements so that we know that every step professionals are looking at this agreement and are handling it appropriately within the private financing and public financing worlds. Development agreements to further support these issuances, as well as TIFs, and then also what position would we be taking within the capital stack structure? Are we, equity, mezzanine? Where do we stand on those types of issues? So
We don't want to be equity, we don't want to be mezzanine.
right, definitely want more of a senior position.
Yes.
So the general structure of this is looking at a joint partnership with the DCFA, the Treasurer's Office, county commissioners, as well as the other needed parties. The local jurisdiction infrastructure bond funds will be subject to the Treasurer's approval, but leveraged through the DCFA. The DCFA bonds would be under the discretion of the DCFA and the Treasurer's Office, with the advisory board reviewing and providing recommendations to the Treasurer's Office on if these should be issued or not. And then a annual review being provided to the advisory board concerning each of these transactions that would be undertaken by a financial advisor selected by the Treasurer's Office in consultation with the county administrator. The investment overview for the infrastructure and DCFA bonds. There's a lot of information up here. It's been provided to you in Word format as well as this PowerPoint, but very quickly, looking at 3.75 interest rate as a starting point for both the infrastructure and the DCFA bond fund. This would be contingent upon market conditions, though. We are not guaranteeing this rate because it needs to be competitive. It needs to be in a situation where we are doing right by the county. Those funds would be broken down upon the interest rate earnings for the various parties involved to cover costs that they're undertaking, as well as to provide funds that can be put back into the community for a variety of needs, whether through the DCFA or entities such as the land bank, so that it can continue to provide support to the community in each of their specific areas.
You thinking fixed and variable, Bob, or just fixed, or?
Right now, we're thinking fixed, but again, it comes down to market conditions and the overall deal structure. So I'm hesitant to tell you anything. I think we have to be undertaking each project as we would any TIF agreement or financial investment. How does it stand specifically, and making sure that everybody's comfortable at the end of that bond period. And then on closing fees of about approximately 1%, again, market conditions determining it, but those closing fees would be used to allocate any costs that the county treasurer's office had to take on to cover this program, whether staffing or other needs. And then also the DCFA would be able to request of the advisory board an allocation of those funds as well to cover costs that they would undertake in these endeavors. There will be continuing costs through auditing and management of the different programs.
Bob, how did you determine the percentage allocations to each entity? Because if you look at the county's infrastructure needs and things like that, I mean, if you look at the overall budgets, it's pretty, you know, I'm just curious how you come up with those.
Really looking at where each entity currently is from a financial standpoint, making sure with the county being the largest entity from a financial standpoint, getting the largest share, and then making sure that that 2.25 number actually exceeds that 1.9 number that we saw from 2018 and 2019 in the Ohio Star area. The 1% going to the DCFA really to cover a lot of the different land undertakings that are going on. When there's a whole spreadsheet, happy to provide it, but when you look at that breakdown of number, that shows a return of enough over several years to keep making those investments into real properties so that the DCFA can continue to play a role in taking down different properties that are of commercial interest but might be harder for a private individual to undertake, very similar to the process we've taken on 23 at Orange and 23. And then once those numbers were figured out, trying to allocate some funding to the land bank so that it would continue to be able to, I shouldn't say continue, that it could increase its role in being able to take down properties, reposition them, and work with both the DCFA and the county to make sure that a lot of the vacant properties aren't just simply going to the quickest buyer, but going to the right buyer for the community, as we've currently worked on a recent project where I think that partnership has resulted in a great return to the county.
And I'm going to add a couple things. One, I'm going to start with the land bank. You know, I look at the land bank where the finance authority was 5 years ago, just in its infancy. And then I see the land bank in 5 years being a roaring success, like the finance authority has been, and playing an integral part. And the land bank's, I use the word unfortunately, it's unfortunately going to get very busy very quickly. So putting 5% in, helping to cover those costs and making things a little bit easier on the chairman of the land bank going forward in operating. The 1% for the DCFA, hopefully they'll be able to use some of that to build their revolving loan fund. And again, you know, the revolving loan fund that was set up and then was funded, I think we funded at what, 3.25 million?
3.25.
3.25 million?
3.25.
Okay. We're hoping that some of that 1% would go to build that fund up so that at some point we could get it up to about a $10 million revolving loan fund. Again, you know, we're going to start to be able to play with the big boys, and I think that's where it is. And obviously, the 2.25, you know, I'd like to see as much go back to the general fund to continue to increase our investment return, especially with the current market conditions that we have. And I don't think those market conditions are going to change so substantially over the next 5 years. So 2.25 is a pretty good rate when we look at a crystal ball.
Yeah, and I think
The reason why I bring it up is, once again, when you look at that, the general fund portfolio with Star Account, I know it's down right now, but historical. So I think this program, my initial thought on was that it would help generate more financial resources for the county to take on road projects, things of that nature. Now, I think the presentation of these guys at Fifth Third will help that. But I think in this scenario, this is really providing more resources for the DCFA and the land bank, which are great. I mean, I'm not criticizing. I just want, as we go through that, the commissioners to see that point of it.
But this is also going to be part of the overall financial plan that you're going to be right in the middle of, Mike. And so I look at what we talked about today to be more liquid, to be more fluid in moving forward. And so you and the Chief Investment Officer and obviously Eric and Tyler, I'm sure that our COO, Rick Carr, hopefully soon, will be in that mix, and Bob and I hopefully will be. But I think that what we're talking about today is fluid, and that our plan needs to be continually looked at and worked on to determine where the best needs for those resources could be. So they could switch depending on the needs.
And I think the programs are very strategic. When you sit and deal with a lot of the development, things, and there's going to be a lot more with 23 and Berlin Business Park. And as you see more commercial and manufacturing investment, those are not residential guys have been around here a long time. They know the drill. They know how the infrastructure. They've been doing subdivisions all over. These folks are going to bring in their engineers and their developers from their corporate, and they're going to find along 23 and 36, 37, there's a lot of infrastructure that's involved. So I think that this program is excellent. It's out front of that because at the end of the day, it's usually Bob and Eric and I in a room trying to figure out how to close a gap. And the gap's going to get more with commercial or industrial because the land values, what they can sell are probably not going to be as easy as residential. So I think it's excellent. I think we just, when we set that program, like you said, it needs to be fluid. We need to make sure that if we're helping those types of businesses that we understand, we already know from a county standpoint, going through regional planning and our processes are going to need to speed up. So helping them with these programs are going to have to be fluid and be to a place where we can get that need, that those programs out to help them and not have it be 6 months till they have it and stuff like that.
And I look at Delco Water and Suburban Gas and those types of not-for-profit entities that would be perfect for the middle loan, which was the one for municipalities and it doesn't have to be just municipalities and townships and cities. So yeah, I agree with you 100%.
So just very quickly to wrap up, the local jurisdiction fund would operate in the same manner as the other one, just at that different interest rate of 1.75, again, trying to support the local community.
Correct.
Going to the point that County Administrator Fromer raised, you can kind of see the financial return on this program. Obviously, the allocation of these dollars does not provide the same return to the county as the investment overview that JP Morgan Chase just went through. However, what I would tell you is it does show a higher rate than what has been being secured in the Star Ohio account. Looking at current rates of today, you will see the difference there on the 20-year return under the infrastructure compared to Star Ohio. When we do change that to address that average of 2018, 2019 years, we actually still see a slightly higher return under this program than you would under the straight Star Ohio. So again, not from a straight number standpoint does it address that, but it does still maintain above the Star Ohio while providing us a mechanism to secure that commercial investment, that light industrial investment that furthers other goals within the community and lays the basis for property taxes to be coming in, which is an additional income stream for the county to be relying upon. So it sets the stage to build over time with the investments in the community. And then the target investment criteria, looking at infrastructure, job creation, industrial, commercial investment, public safety services, and quality of life projects within the community. So again, looking at those YMCA type projects that Treasurer Ranke recently worked on with Liberty Township, as well as then that more economic development driven infrastructure, light industrial, commercial development type opportunities. And that's everything I had. Happy to answer any questions. And I think I finished with 1 minute to spare from what I was told.
You always do a good job.
So what was your target maturity, like for the infrastructure, bond fund or bond program?
So how many years were we looking for issuances?
Right, well, kind of as a target maturity.
Between 5 and 10.
Yeah.
5 and 10.
Yeah, between 5 and 10.
We used a rough 4-year issuance type process. Just how quickly would those dollars go out the door, and then 5 to 10 years with each of those kind of years looking at it.
The reason for my question was we were looking at a 20-year.
Yeah, I know, and that was the typo.
Okay.
I mean, there's the only way to really do that is to do a 10-year and then do a, this is something that we've talked a lot with Tyler and Eric about, to be the worst case, be a 10-year term with the ability to properly recycle it so that there could be another 10-year, but it would be a new issuance so that we would stay within compliance. And you're going to be right in the middle, George. You're going to be right in the middle of this as a member of the advisory loan committee. So, and I look forward to working with you on this. I think we can do some good work. I'm getting a lot of calls from, obviously Liberty Township is, they want to do administrative building. They want to they want to build a new firehouse to replace 321. They want to do a couple other things. But I've gotten calls from Genoa Township, Orange Township, and I think I think we may get calls from the city of Powell and the city of Delaware, because 1.75% is a pretty good number. The way that the county has grown, the smart development concept with the JEDs and the TIFs have substantially improved the financial strength of a lot of the townships that they're being used in. So we'll make sure to do everything we can, George, to keep the risk at the level that you might see in Star Ohio, because I think we've thought these things out as far. I think we've spent a great deal of time, literally over the last couple of years, trying to think through some of these concepts. So, and again, they're going to be fluid, and they're going to change based on what's going on in the market. And I think we've got a great group of the 5. And what we're doing is building off the great job that the commissioners have done over the last, 8 years or so, to be able to get us to a point that we could do these types of programs. Because probably 8 years ago, we would never have been able to do these types of programs. So,
Yeah,
if I could just add in real quick, just on the 20-year, Don had raised that point to me before on January 510. We do all of our TIF analysis at 20-year, and since we were trying to build it into the Berlin Park model and then back it out, I just kept it 20 so that I wouldn't be showing 2 different numbers possibly in the same presentation. So,
As long as the star rates move up, will these rates move up?
we're allowing for that flexibility within it at the treasurer's discretion.
It would make sense to move up accordingly.
And that's where we.
Otherwise, end up with rates that are unattractive down the road.
And that's where we did talk about.
We're looking at the ability to have 1 year adjustments, that each of these funds would have an adjustment after 1 year, that they could go either up or down depending on the market.
This is fine, I don't see them going down, so.
No, I don't either, but I do think a 1.75 starting rate is a great rate. And then the 3.75, how we came up with that is basically those funds for the infrastructure loans. A lot of the developers unfortunately have to look at mezzanine loans, and those loans are in the 5.5 to 5.75% range, and they have some pretty heavy upfront costs, and it's short-term money. And so us being at 3.75, and then we are going to charge 1 point origination fee.
But if those rates go to 7 for the developer, and we went to 5, it's still attractive.
Yes, it's still very attractive for them. Yes, thank you.
Don, you brought up a really great point. The commissioners really have installed over the last 8 years a proactive approach to business operations. That's what, when people ask me what we've been doing, it's that. We used to be reactive. We used to use the Ohio Revised Code with all the requirements to say, well, we can't do this, we can't do that, we're going to stay stagnant, we're going to be reactive. We've become proactive in a lot of areas in the financial management, what you laid out today falls in line with that. It takes more work. You got to look at everything, daily and adjust and stuff like that. And so I think it's great. With the programs, the goals that you have in mind with smart growth and increasing the portfolio is excellent. As we navigate, 135 or 130 or 153, and the Ohio Revised Code, the prosecutor's office, Eric, may tell us stuff we can't do. We need to keep navigating and coming up with solutions to get there. That's the change, and you're bringing that, and that's great to see, because it falls in line with what we've been doing on the development front.
And I appreciate that, and that's the reason why I decided to run to be treasurer, because I thought that, we have a great team, and actually, I think there's just these opportunities, and I'd like to, I really wanted to be a part of it. So that's, in a nutshell, why I wanted to join the team. Obviously not for the pay. I think I took a little bit of a pay cut, but.
One
Okay.
other comment I just want to make. I've had a couple conversations with the state treasurer's office and the state treasurer personally, and they're interested in what we're doing here. They are interested in putting a program like this together. They aren't nearly as far along as we are in terms of having a structure to it, at least. But they're interested in possibly investing in local governments as well as their own programs. So there could be some funding there as well as our own internal funding. And they've got billions of dollars versus our 250 million. So again, they're interested. It's good to know.
Bob, could you get George a copy of your presentation?
Yes.
Yeah, that would be great. I think we're about ready to go into session here, so if I hear a motion to adjourn the meeting, I'll move that, or you, okay, I'll second. Discussion, all in favor?
Aye.
We are adjourned.